Our Meera Pandit is over at JP Morgan Asset Management and is the global market strategist there. Meera, it's great to have you on the program this morning. Again, there's been a lot going on in the markets today, but of course, a lot of attention specifically on the Federal Reserve. We heard from the Atlanta Fed president this morning saying that he was on the lower end of the spectrum in terms of the amount of rate hikes he could see over the next 2 years. I'm just wondering broadly how you're viewing a lot of the market action and whether or not it's the Fed, geopolitics, or something else that's really driving what we're seeing so far.
Well, market volatility cuts both ways. We have up days and we have down days. There's still a lot of uncertainty around how the Fed is actually going to implement its tightening throughout the course of this year. And of course, from a geopolitical perspective, a lot of uncertainty with regards to how that continues to proceed. But I would say that one headwind that has actually abated so far year to date is the fact that we came into the year with very high valuations on the equity market, and those have reset to some extent. And I think that all of a sudden it's becoming a little bit palatable for investors when we look at valuations in some areas of the market. So you're seeing that bit of a relief rally last week and into this morning so far. But the question is it durable with all of the headwinds that we do continue to have from the Fed and from geopolitics?
Now, I might wind up a little bit on this one, but we've been hearing a lot of people talk about the yield curve, the possible inversion. And again, indeed, when we look at, for example, the spread between the U.S. 10-year and the U.S. 2-year, we are getting very close to a negative yield between those two things, which has historically been a bellwether of a recession. But what's interesting about the dynamics in bond yields is that when you take a look at different sides of the curve, the 3 and 5 is already inverted, but the 10-year and the 3-month has actually increased in terms of the spread between those two instruments. So I guess from your perspective, how useful is looking at the yield curve when you take a look at the volatility, for example, on the longer end of the curve in the 10 and in the 30-year?
There's some real distortions in the yield curve right now. And if you think about all of the different levers of monetary policy that are weighing on different parts of the curve, it's actually quite different than what we saw over the course of the last tightening cycle, where you saw tapering, rate hikes, and bond purchase, reduction, balance sheet reduction occur spaced apart. This time around, they could all occur within the matter of a couple of months. So you have aggressive rate hiking from the Fed being priced into the shorter end of the curve. The 10-year is reflecting the end of tapering and perhaps balance sheet tightening coming up ahead. Look, the Fed owns about 25% of the Treasury market. So as the Fed becomes, rolling off its balance sheet, that is going to have real upward pressure on yields. And then all the way at the longer end of the curve, if we think about the 30-year, look, central banks around the rest of the world are still, a bit less aggressive than the Fed. So if there's yield in the United States, that's going to continue to face demand from abroad. So a lot of competing impacts that I wouldn't read too much at this stage into a yield curve inversion.
Okay, I love that because that means that we can just tell our viewers, hey, don't worry about it for right now. I guess the overall question for people that may not have even known what we were talking about over the last two questions is, look, do I get into stocks? Do I get into bonds? Do I get into other asset classes right now? What do you think is the strategy given all of the craziness that we've been seeing across asset classes the last few weeks?
On the fixed income side, it is still a challenging environment for bonds. I think it's really important to set expectations with clients about what bonds can potentially do in a rising rate environment. And yet we typically have seen during shorter and sharper Fed hiking cycles that areas like shorter duration tend to benefit investors. And we have seen some spread widening in the credit markets, which could also make that potentially attractive if the economy continues to be on solid footing. And then on the equity side, look, again, valuations have broadly reset. That doesn't mean we should aggressively buy the dip, but as of last week on the first day of the rally, about 25% of the stocks in the S&P 500 were effectively up. And what that means is there's going to be a smaller number of losers, a smaller number of winners, a much larger number of losers this year. But in effect, there are still opportunities. And we anticipate 10% earnings growth on the S&P 500 this year, which means active stock selection can provide some opportunities for investors in 2022.
So if there are fewer winners, but you do anticipate that earnings will still grow by double digits this year, then who are those winners going to be in terms of either industries or perhaps profile of stock, right? Because there's been a lot of focus on the rotation between growth and value. Is higher rates going to impact, for example, those tech stocks more than, say, your value stocks like a Ford? Is there anything to be read from that?
Unlike last year, I don't think we can view any industries or sectors as a monolith. I mean, you're seeing it right now with big tech as well, where there's some real differentiation between some of the different stocks within that area, whereas over the last 18 months to 2 years, they all kind of went up in tandem. So I wouldn't view any one area of the market as a monolith in terms of performance, but we have seen that value has outperformed growth year to date because it is somewhat of a supportive backdrop, given that inflation is high, growth is still pretty strong, and rates are rising, and that tends to be a good environment for value stocks. So it is an area that I would lean into. But at the same time, investors are going to need growth in their portfolios as we slow from an environment of above trend growth to closer to trend. So we're really advocating at this point for good balance and good diversification. You diversify when you don't know what's coming ahead. And I think, again, there's a lot of uncertainty. The economy is still strong, so it is supportive for stocks. And yet we don't want to necessarily put all our eggs in one basket in this type of market.
All right. Eggs in a basket. Perfect thematic kind of way to end that with Easter coming up. But Meera Pandit, JP Morgan Asset Management, Global Market Strategist, thanks again for stopping by this morning. Have a great week.